30% of M&A deals these days end up in renegotiations after they've been signed. And one of the biggest reasons we've seen is because buyers do not sit and look closely into the numbers before they commit. It's like there's a rush to commit because of different reasons. So today we'll be talking about the financial exercise that is at the heart of every smart acquisition, which is financial due diligence, right? Today on Business Pulse with Kreston Pedabo, I have two transaction advisory professionals. One, Adeshegun, here with me, who has experience on buy-side due diligence. He has worked on deals across several sectors. I welcome you, Shegun.
Thank you, Farida, for having me.
And on the other hand, I have Christiana. Christiana has experience spanning the sell side transactions. She has worked on vendor due diligence. She has worked on working capital transactions and other transaction advisory exercises. Welcome, Christiana.
It's my pleasure being here. Thank you.
Okay, so let's get right into the heart of the conversation this morning. So I will start with you, Shegun. For somebody that's never heard of the term, right? How would you explain due diligence in an M&A context?
Okay, thank you, Farida. Yes, so first of all, before we even go to financial due diligence, it is important to establish what a due diligence is, right? So due diligence at its core is seeking to go deep or deep dive into the financials or reports of any company, right, that is going to be involved in the transaction, right? And by transaction, I mean acquisition or sale, whichever form, right, of their company. It could also be by an individual right here. And then there are different kinds of DD, right? There is the financial due diligence, as we'll be talking about. There is the tax due diligence, and there is the legal due diligence, amongst others, right? So to now answer your question on financial DD, right? So financial DD, what we're typically doing is to go back to analyze the historical data, the historical financial information that was provided to us. We check the quality of earnings of the seller company or the target company, as the case may be. We are checking to be sure that whatever has been reported on the face of the financials or on the face of whatever the company is positing to be is substantially the same when we dig deep and we investigate.
Thank you so much, Shegun. Christiana, I would ask, and I have picked something from what Shegun is saying, right? When he got into explaining what the financial DD is, I was hearing things around audits, like you're looking into the financials of the company, you're trying to dig deep. So I would ask, when people hear this now, they would think, oh, okay, audits. But do you think it's different from the standard audit, and how is it different if it is?
Okay, yes, thank you for that question. That's a very important question, right? Because this is a very common misconception we encounter. So financial due diligence and audits are completely different, right? So people will put audits and financial due diligence on the same spectrum, but in reality, they serve very different purposes and answer very different questions. So an audit is about assurance on historical financial statements. So the objective basically is to express an opinion on whether the accounts present a true and fair view in accordance with the relevant standards. So the mindset is purely compliance and consistency. So auditors are looking for material misstatements, whether the numbers are fairly stated for the users, right? But financial due diligence, on the other hand, is about decision support for a transaction. So it is not just trying to say the numbers are correct. It is trying to determine whether the business is worth the price being paid and what risk sits behind the numbers. So the mindset is commercial and forward-looking. So an auditor will ask, are the financial statements materially correct? While an FDD professional will ask, what will I actually earn if I buy this company? So audit is backward looking, while financial due diligence is forward looking, right? So for example, your revenue the auditor is looking, are you presenting this revenue in accordance with IFRS 15? While in financial due diligence, you are looking at there, of course, while we acknowledge that, okay, your books have been audited and then you are rightly recognizing your revenue in accordance with IFRS 15, are there aggressive revenue recognition policies?
Yeah.
So another example is you are making a revenue of 50 billion and you're happy that yes, I have actually met a target, right? Which is like an all-time high. So while just looking at it at the surface, looking at it on the financial statements, you will not see some things. What exactly are those factors that contributed to that 50 billion revenue? How many percent of your customers are contributing to that 50 billion? You see in some instances where some customers are contributing, let's say 5%, the top 5%, top 5 customers are contributing up to 70% of the revenue. That's like a very big red flag. So while of course I'm making good revenue, but these customers, like the saddest part is you see some of these customers are not even under contract with the company. So these are the things we look at in financial due diligence. It goes beyond just the numbers.
Okay.
And just to add to what Christian has said here, I always say it around that a clean audit or a clean audited financial statement does not necessarily interpret to a clean company, right? Like she pointed out, there could be a lot of circumventing, window dressing, whatever thing, behind the numbers. So we have seen instances where audited financial statements, after reviewing them, are substantially incorrect, right? So yes, that's really where DD proves to be different from an audit.
Okay, you've heard from our experts. So financial DD is not just about trying to comply. They go deeper than the assurance part. They dig deeper. After the auditors can, like Segun has said, the auditors can give you, oh, this is great. By the time you dig in deeper, you begin to see, okay, this might not be of value to our customers, which is absolutely fantastic. Okay, again, I would like to ask Christiana. So when you're walking your buyer into a transaction, what are the most critical factors you would say they need to examine?
Okay, the first thing I would say is the quality of earnings, because this really is the centerpiece of any due diligence engagement or exercise, right? So you want to strip out all the noise, right? All those non-recurrent income, those abnormal provisions, you want to take them all out. What you're trying to achieve here is the real maintainable EBITDA. So that earnings that gives a true reflection of what the company is actually capable of earning on an ongoing basis. So here you want to ask the difficult questions on whether whether there's revenue sustainability. You are asking questions on the cost structure. You are asking questions on customer concentration. So those are the things we look at under the quality of earnings. So here you're trying to stress test the earnings to see what is actually repeatable as opposed to what is opportunistic, right? The second thing I would say is the net working capital. Here, you're not just trying to figure out, okay, what is the net working capital of this company? You are trying to figure out what is sustainable. What is the sustainable net working capital? Here, you are trying to analyze how the receivable, how your payables, how your inventory, how they behave on a normal basis, right? So, and you're also trying to see whether the business is being managed to flatter their cash position just ahead of the deal. So another thing, the last thing I would like to add is the net debt and contingent liabilities. So the most obvious ones here are the bank loans, your shareholders' advances, but the real work is in uncovering those obligations that are not easily or immediately seen on the face of the account. Say, for example, those additional tax exposures, customer disputes, pending litigations. So these are the things that could one day in the future, lead to future cash outflows, right? So these are the things you want to uncover before you go right into the deal. So these three things together, they give a clear picture. They give the buyer or the investor a clear picture of the company's financial position.
I'm sorry, if you don't mind me
Yeah,
asking
definitely.
again, right? So, Christina said earlier about the revenue quality when she was explaining the difference between audit and financial due diligence. So, basically, we have seen instances where a company will posit 60% revenue coming from maybe a single buyer, right? I mean, sorry, a single customer, as it were, and there are no contracts to it. The fact that a large chunk of or a chunk of your revenue is coming from a single person, that would not be so much reported in audit, and that is one of the things that we try to figure out. And then in our review, we are then checking, are there contracts between the customer and yourself? Recently, we had a case, we had a client whose two major customers pull out, right? And because of that, their revenue projection dwindled, right? So you can imagine having to rely on. So when we do a due diligence for a potential buyer, we help you to realize what are the potential risks or what are the current events ongoing within the company that you should be prepared for. That you want to go look for a key customer ahead of acquisition or whatever you have to do as a preparation.
I like that. For financial due diligence, it looks at long term also.
Exactly.
So in your findings, you're also trying to say, oh, okay, this might not be an issue now when you buy it, but in 3 to 5 years, this can be a serious issue.
As a matter of fact, when we are giving recommendations, so when we do DD, we have our report saying the gaps, the recommendations. So when we're giving recommendations, some of the time we have timelines to say, okay, maybe get this done, but then because of our evaluation of you can do this within 80 days or 90 days post acquisition. You have to do this immediately after acquisition. So that's just to substantiate your point.
That's amazing. I'm going to shift the gear a bit. Because I know that when people talk about DD, and you've mentioned this in your explanation before, I've heard about tax DD, and the way people look at it when they are when it comes to due diligence in general, they treat it as a separate work stream, as though it's not as important as the contents we are talking about now. So how would you explain that?
So definitely, tax due diligence is quite a separate work stream. However, it is as important as a financial due diligence. If you ask me, all the kinds of due diligence, the entire due diligence framework is very important to a transaction, whether it is tax, whether it is financial or legal. But in tax, how tax is different from financial DD is that they look at, the tax DD experts look at the substance of the tax figures that have been reported. Are there undisclosed VAT obligations, for instance? Are there PAYE issues that have not been fully remitted? Are there some other are there related party transactions that have not been conducted at arm's length? I know all of these things have their several tax implications when you do not fully comply. All right, so those are the things rather that a tax DD person would look at, and at the end of the day, they come up with a tax exposure or tax liability computation to say this is what this company at this moment is exposed to based on our review, and that again informs any buyer to say that, oh, this company that I'm looking to buy, these are the potential obligations that I have to maybe immediately meet or find a way to address.
Okay, go ahead.
Another thing that is worth mentioning is how vendor due diligence is becoming a common thing in Nigeria, right? So this is where the seller commissions their own FDD reports just ahead of the deal. So they don't wait for the buyers to come up with the reports. They come up with the reports on their own. So this really helps in when it comes to managing the timeline once the deal starts. It also gives the seller a chance to remediate some of those key issues, right? Just before they become a deal killer.
To substantiate that, late last year we had a client who were looking who were looking to raise funds. And then what they did was to approach us. A vendor did, and then asked us to look at their books, conduct a proper due diligence, and as of now, from what we know, they have started implementing those recommendations ahead of even trying to raise funds.
That's amazing. Right. That's amazing. What I wanted to also ask is that, is it proper, maybe as is the word, is it proper to decide to just do maybe like a financial due diligence without doing a tax due diligence? Because I feel like they are kind of intertwined, because your taxes also affects the revenue of your company. Definitely. Right? So if you're not, probably if you've been evading tax for a while, it can come back and end up hurting your finances or even your books entirely, right? So I just wanted to know, like, is there like a thing where you just decide to do the financial due diligence, or like how does that come into a full picture?
Well, typically, what we have seen commonly is a financial DD going hand in hand with the tax DD exercise. In fact, our reports typically are always holistic, capturing the financial bits at the base level, financial and tax DD. They always come hand in hand.
Okay, that makes a lot of sense. So my final question to both of you: what do you think what have you seen as the biggest mistake people make when it comes to a due diligence?
Oh, that one thing that comes very quickly to mind is the rush that you said in your introduction, right? So because of timelines, because of the competition, the stiffness in competition around trying to raise funds and all of those things, companies or buyers typically sometimes want to rush into the exercise to say, I want to buy this company, I want to buy it right away, without having to do the detailed investigation into the substance of whatever the company you want to acquire is, into, right? And that at the end of the day, sometimes, if not oftentimes, results in certain levels of regret, because if a DD is not properly done, certain things will not be uncovered, right? It's not okay to just rely on an audit, really. So just stay back. It's better to really just hold off a bit, conduct a proper DD, and then make an informed decision rather than rush.
So in addition to Adishegun's point, I'd also say when clients or buyers or investors treat due diligence as a compliance rather than a decision-making tool, right? They just go ahead to tick those boxes, and then they don't integrate the financial due diligence findings into their deal structure. So at the end of the day, after they go into the deal, they start facing some kind of issues because all these things that have been flagged before, they ignored them. Exactly.
Okay. I didn't know much about due diligence coming into this, but I would say my biggest takeaway from what you have said is that even with audits being done, they've given you the assurance that these are clean. There's a lot of window dressing and sugar coating that can go into a company's maybe books, just to ensure that it can be sold or the buyer is able to buy it as quickly as possible and they're getting out of it. So your work here is more like, I would say, detectives. We're coming in to look at, this is what the report is saying, but we must dig deep. We must go into the nitty-gritty to find out, so that people are not ending up buying troubles instead of big financial assets, right? So thank you very much for your intelligent takes on this on our show this morning. We hope to see you again in bringing in more deeper insight into other topics.
It will be a very great pleasure. Thank you for having me.
It's my pleasure. Thank you.
Thank you so much.